Welcome to the Lighthouse Financial Advisors Money Over 50 podcast with Dallas Davison and Michael Hogue. This information is general in nature and does not take into account your objectives, financial situation or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Lighthouse Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50. Today, we've got a topic of yours, Michael. 5 legal loopholes to take advantage of.
What if I was to tell you that I had a magical company, that everything you put into this magical company, when you retired, it would pay you back tax-free? So you could take a tax-free income from it and you could make a rate of return. I talk about your money working for you when you retire. Any money that this money in this magical company makes is subject to 0% tax. Is that something that you'd be interested in?
I was wondering if you were going to launch into that spiel again. This is, for anyone listening, this is the second time we've tried to record this. We had some audio glitches the first time around, and so I thought to myself, I wonder if he's going to be able to get himself amped up to do the same spiel at the start of it. So yeah, so I'm pretty impressed with that. So yes,
but
Michael,
wait, there's more. But wait, there's more. What if I were to tell you that along the way, as you put money into this thing, you can actually claim a tax deduction for that money that you're putting in there. So not only does it pay you money out tax-free in the future and have a 0% tax rate once you're retired, along the way, 10 years out, 15 years out from retirement, you can put money into it every year and claim that as a tax deduction.
If you call now, I might be interested in.
If you call now, if you call in the next 15 minutes, we can. No, so all jokes aside,
yeah.
This is actually our superannuation system, and what we're going to take you through today is in chronological order.
Yeah.
Like we call it, 5 legal loopholes to take advantage of, and ending up with the mecca that I just described there. So
yeah. And I think the good thing about this, I actually like the structure of this, and obviously I can talk about it because we've done it before. But if you think of it as like we said, even though you've spun it as there's a magic bullet, what actually happens is there's 5 in this case study we'll go through. There's 5 different components of this strategy that all add in together, and the sum of the parts is pretty massive. But that's I think what happens with, we've talked about this before a lot with all of our planning and looking at this with people. There's no magic bullet. It's just using every different part of this to get you the best outcome along the way. So the 5 separate steps here, it's a good way to break it down, ending in that holy grail that you just talked about, which is a tax-free retirement.
That's right. And what we're talking about today is legislation. So it's the legislation part of what we do. Now, legislation is black and white.
Yeah.
And when we talk about legal loopholes is a term. What it means to me is actually about understanding the legislation and using it to your advantage legally. So that's what we try to do. So we use the existing legislation. We look through that legislation, and we say, look, how can we get strategy out of this, and actually how can we make this fit for our clients?
And that's a good point. There is I guess to add a bit to that is the way that I think of it is not just. It's not just what does the legislation say. You almost got to think of it from the perspective of what does the government, where am I being guided in what direction? If that makes sense. And so what I think of with this is that like a lot of the legislation that seems sort of too good to be true, or why are these rules in place? The holy grail for our clients and for our government is for everyone to be a self-funded retiree. So each of these things, it's not as though it's a little trick that we've come across that wasn't intended to be used by our government. And even though we call it a loophole, but really it's a thing that's been left open for a reason. the government wants you to take advantage of these tax savings along the way, so that you will then be a self-funded retiree. And so it's really a good position to be in, because what you want and what the government wants are the same thing. I mean, in a perfect world, they'd probably like a little bit of the tax money along the way, but they can kind of see that if you've got someone who's 55 and they're working towards retiring in 10 years' time, there's two ways it's going to go. They're either not going to be self-funded, in which case the government's going to have to put their hand in their pocket and pay for some Centrelink and things like that, or they can give them some incentives along the way, let them pick up some tax savings, and get to a point where their retirement is fully funded by themselves. And that's kind of what the government wants, and that's what I think most people listening to this probably want.
Yeah, look, it's funny, isn't it? Because I don't even try to. You've done a great job of explaining what the government wants, and I think that's a valid theory.
You don't care.
I really don't care, because it's pieces, it's words on paper now.
Yeah.
And if I can look through those words on paper, which is all legislation is, it's words on paper.
Yeah.
And if I say, I can do this, I can do this, I can do this for my client, where I can really add significant value for my clients is by coordinating all of that together.
Yeah, and that's probably a good point, because it's a bit like there are some rules that just don't make sense to me at all in any view, and it's a bit like a dog turning in a circle before it lays down on the floor and goes to sleep. Why does the dog do that? That's just what the dog does. You can try and argue it, you can try and understand it, or you can just go, okay, the dog's going to do that. So the law is the law, the rules are the rules, and obviously they will change over time. But that's, as you say, our job is really just to go, this is what the rules are. This is what we can do in the most effective way for our clients.
So let's talk about these 5 things. Five specific pieces of legislation packaged together. Now, just bear in mind, as you're listening, the mecca here is what we want to end up with is when your retirement is, you want to end up with the most amount of money that you can in this magical tax-free company. I say that with air quotes now. It's just superannuation. So you want to end up with all of your assets that you're going to draw an income from up to, there are some caveats there. We'll get to that in a minute. But you want to end up with the bulk of your money inside superannuation, where you can then flick the switch effectively and move that into 0% taxed on the earnings and on the income that you draw. So it's the ways to get that.
That's actually a separate podcast that we've also done about taxes in retirement, and so that's. If you want more details about the specifics of how all those sorts of things work, and we'll touch on it a bit towards the end of this, but that is another whole area of its own. And so what we've sort of got today are the 5 steps to go through on the way to that end point. But you're dead right, is that we want to start with the end in mind and go, that's where we want to end up, is in that tax-free environment, so that when you're retired, every dollar that you've got that you're drawing out is going to you and not going to the ATO.
That's right. Number 1, concessional contribution. So imagine for just a minute, you're 55 now. You don't have to be 55. There's no age-based limit on this. It's just that generally speaking, at that age, people are very focused because they have 10 years traditionally 10 years to go till the traditional retirement age of 65.
Yeah.
So you could be 50, you could be 45. It doesn't really matter. Just imagine for a minute that your employer puts in $10,000 to your superannuation fund each year. What that allows you to do is you can actually put up to $15,000 in to your superannuation fund per individual. So it could be $30,000 as a member of the couple. Yeah. Because you've got a $25,000 concessional contribution cap. So effectively what concessional contribution refers to, it's just money that you're going to put into superannuation and claim a tax deduction for.
Yep. So you don't have to pay income tax on that money.
That's correct. So in this example, if my employer puts in $10,000, I put in $15,000 throughout the year via salary sacrifice, which is the most common form of that. Or I can now do it a different way, which is putting it in from after-tax dollars and claiming it as a tax deduction at the end of the financial year. Don't get too worried about that. It's the same thing in a different coat. It all comes down to what marginal rate of tax I'm on. So if I'm on a 39% marginal rate of tax, which means my income's over $90,000, I think it is now. Yeah.
Yeah.
What happens is that I put that $15,000 in. I claim that as a tax deduction, and I get back $5,850 as an additional tax return. So it's just my marginal rate of tax, 39%, times the amount that I've put in. And if I'm in the tax bracket below that, it's 34.5% as my marginal rate of tax. So I get 34.5% back of that amount.
Yeah. So still definitely worth doing. It's yeah.
So that goes in my super. So as it goes in, and I claim it as a tax deduction, the super fund then taxes that at 15% on entry. And what's important here is that 15% tax is only levied on money that is being claimed as a tax deduction. So it's either your salary sacrifice or the money that you put in and claim as a tax deduction at the end of the year, or your employer contributions. So essentially, though, there's an arbitrage there, because what happens is I put the $15,000 in, and I claim that at 39% rate of tax in this example. So I get back 39% of that. I get taxed 15% of that as it goes into super.
Yeah.
So there's a 24% overnight return, which is important. So that's it. Look, it's hard to get a 24% guaranteed return over 2 years or 3 years.
Yeah.
If you can get a guaranteed return overnight, and it's guaranteed because the legislation's in place.
Yeah.
And we know that if you do it, you can claim it straight away and effectively get that return. So that one for us is a huge one, because forgetting about the return, the biggest hidden benefit here is, even forgetting about the tax arbitrage, the 24% differential between the fact that I'm claiming that contribution, I'm getting back 39% of that, which is $5,850 extra personal tax return. I'm paying 15% tax on entry, which is only $2,250 in tax levied on entry. The difference between those two is $3,600. We call that free money. Forgetting that, by putting that extra $15,000 in each year to my superannuation fund in the last 10 years of my working life, at a after-tax return of 6.8% assumed, my superannuation grows by $174,500 over that period of time.
And that's a really good point, Michael, is that the free money's great. And that's, obviously if someone handed you an envelope with $3,600 in it every year, you'd be clicking your heels. But it's this is why we talk about this for most people when they're 55. This is when this really becomes front of mind. It's because the limitation on this is that money goes in super, and you can't get that back until you've met a condition of release. But when you're 55, that's actually what you want. You want that forced saving. You want when retirement it's coming up soon. Whereas if you said to someone who's 30 years old, hey, you can put this money into super and you pick up the tax arbitrage, but the downside is you can't touch this money for 30 years, regardless of what happens. It sort of becomes a bit of a harder task to get motivated to do that. Whereas when you're 55 and you go, hey, we're geared towards this last 10 years of our working life, even if there was no tax saving, we would be saying to people, you need to be putting this money away to build up your retirement savings.
That's right, and that's a good point, and it's a good point to raise my theory here. So my theory,
I love a theory.
So my theory, so people are suspicious of superannuation, and my theory is the government makes it attractive for you to put money into superannuation because they're saying, we'll give you a tax differential here, and people become suspicious of that.
Oh well, imagine that's exactly what I mean. Where you go, if you think of it from the perspective of what's the old saying of the most the scariest words in the scariest sentence in the world is, I'm from the government, I'm here to help you.
Look,
that's what you've got.
Let's spin this around for a minute. And going back to that mecca. So you can get, and I'll bring up the figures right now. So each individual can have $1.6 million in this magical company by the time they retire, where there's 0% tax on whatever that returns and 0% tax on the money that they draw as an income. So a couple can actually have $3.2 million if they do it correctly. Now, if the government was hush-hush about that and said, we don't want anyone to know about this, and anyone that puts money into this thing, we're going to tax them more in the lead up to their retirement because they've got it then tax-free, this thing would spread like wildfire.
Yeah.
People would go, oh, my God, the government's got this thing. There's a secret thing.
Yeah. What they should
we've got to pay a bit
is,
more tax on the way in.
For a few years, they should say, oh, no, that's only members of parliament are eligible for that, or only public servants are eligible for that for a few years, and then say, right, the gates are open, everyone can use it. And they go, this is what these politicians have been getting. This is the free money that they've got. That's a great idea. Because I think that's why people are suspicious, and superannuation has been that thing that your employer pays into and people aren't actively interested in it and all of those types of things. But what we see it as, it's just a vehicle or a tax shelter. Let's call it a tax shelter. People understand that. Yeah. And the tax shelter that I love is that every dollar that I put in up to my concessional contributions cap limit of $25,000. So the example that we just used then, my employer puts in $10,000. I put in $15,000 in. I claim it as a tax action. I get a 24% return overnight. Essentially, I claim it at 39% if I'm on that marginal rate of tax. I pay in 15% going in. There's a free money percentage of 24%. Hey, it goes into an environment that's only going to be taxed on the return at 15% before I retire. So every year, whatever that money makes, I get taxed at 15% internally. Hey, that's a lot lower than my marginal rate of tax outside of superannuation. If I'd invested that money in my own name, I'd pay 39% tax on it. And when I get to 60 and retire or have a change in employment, I can move all of that money into a 0% taxed company, in inverted commas. It's still my superannuation and goes into a superannuation income stream. And it's 0% tax then forever. So I think that's why people are a little bit skeptical. It's just been and disinterested because for a long time it's been just something that their employer's done and they haven't taken an active interest in it. Yeah, it's been mandated by the government. It's those types of things generally get people disinterested or skeptical. And this is like what we're talking about today, and you sort of touched on that earlier, is that once that money goes into your superannuation account, you have the choice of how that money is invested. We're not even talking about that today. We've banged on about that for many, many hours on this podcast. But what we're talking about, and that's, I think, part of why people are hesitant to put money into their super fund, is that they maybe aren't comfortable with or don't understand what's going on behind the scenes there. And so it's sort of a black box of put money in, it either goes up or it goes down. I don't really get it. And so I'm just not comfortable with it. So that's a separate issue, which you need to obviously look at, and it's a very important thing. But this is just, as you say, pure black and white legislation, tax savings. There's no magic behind the scenes there. It's just that these are the things that you can do every year, and you're picking up those returns by way of tax savings.
That's right. So biggest benefit of this one, so putting that $15,000 in each year, biggest benefit of this is that my super grows by nearly $175,000 over the last 10 years of my working life. Hey, if I push that window out and I do that with 15 years to go, it actually compounds out to over $300,000 extra. So that's the power of compounding. Yeah. Go back and listen to episode 3, drive a $15,000 car to draw an extra $717,000 of income in retirement. That's podcast
one of the all-time greats of the Money Over podcast.
Have a listen to that, because it's all about actually finding $15,000 to put into your super fund for the last 15 years of your retirement. We're using 10 years here in this example, but if you go back and listen to that, it spreads it out over 15 years. It makes a huge difference. So, and the other hidden benefit here I put $15,000 in. my super grows to $174,500 as we discussed over 10 years. I get back a personal tax return of $5,850 every year.
Yeah.
So that's my holiday money. You get husband and wife doing this. And they put $30,000 in each.
Yeah.
They've got nearly $12,000 that they can. We say to our clients, hey, that's your big ticket money. Don't worry about trying to save $12,000. We want you to put 2 times $15,000 into your super funds.
Yeah.
And we'll claim that as a tax deduction. You'll get back, nearly $12,000, and that's your money to go traveling or to do stuff around the house or whatever it is.
Yeah. We and I laugh because we always say, you can either use that to go on a holiday or pay off your mortgage, or you could put extra into super, and you could see people's eyes going, I think option 1 sounds pretty good. We're going to go on the holiday.
Well, it's a nice thing. I mean, all of our clients like to travel, and when we take $30,000 off them, they think that their travel days are over for the last 10 years they're working on it.
That's right. Yeah.
But we say, okay, well, we've got this answer here for you. Like, put the money in, claim it as a tax deduction. It's essentially free money. Yeah. There's a big lump sum that comes to you once a year. Your forced savings have already been done, and away you go and travel there. So, concessional contributions, number one, it is. We would sum this up, Dallas, as the biggest one, wouldn't we? To get you into
for the average person, and we'll talk more about different people and how they're different things that they can do. But for the average person, the average, as you say, the average couple coming in to see us at 50, 55. This is one of the big levers that you can pull, and it's I think a part of, like you were just saying, why this is sometimes it's again seems too good to be true, because the numbers compound out in such a huge way that it doesn't seem realistic to go, you've got almost another $200,000, and what you've had to give up is a few $100s a week, and you've got this big tax refund along the way. It sort of seems like you have to do more. But that's kind of the big one that we see a lot. Is one of the easy levers to pull is that first one. And so the second loophole you've got is a bit of a continuation of number one.
It is. So people always come in to see us for the first time, and they say, what do they say?
So I wish I'd come to see you either 5 years ago. They say 5 years, and then sometimes they go, I wish I'd talked to you when I was 25. And I always say, you talked to me when you were 25, you wouldn't have listened to my story about superannuation and retirement. You would have said, you're a boring old man, I'm going to the pub, catch you later. So, but 5 years is normally the one that they say.
5 years. So we can actually turn back. We say, be careful what you wish for, because we can turn back time effectively 3 years. So it's an extension. It's new. It's relatively new legislation. It's the extension of number one, concessional contributions, and it's called concessional contributions carry forward. That's number 2 here.
Yeah.
And what it is, if someone's coming to see us for the first time in July of 2020, and using that same example, they never put money into their super in 2018-19 and 2019-20. So happened?
That's when the legislation started. Was in 2018-19. That's what we're talking about, the 2 years in this case. But that's sorry, go on.
Yeah, so basically what happens is they've effectively got a spare $15,000 that they could have contributed in 2018-19, and a spare $15,000 that they could have contributed in 2019-20 that they never did contribute in this example. And what I'm talking about there is that their employer put in $10,000 in each of those years. They could have put in up to $25,000 as a concessional contribution, including what their employer puts in. So that leaves them the $15,000 that we used in that example. They never did that for 2018-19, 2019-20. They can now effectively turn back time and use those amounts. It can be over 5 financial years, but let's just do that over the next 3 financial years. So what they could actually do is they can actually put that money in over the next 3 financial years. So
there's $30,000 spare from the $15,000 from the past 2 years. So there's $30,000 extra on top of the $15,000 that they can be putting in every year. So they can put in $25,000 a year for the next 3 years.
Yes, that's right. So it's a great way to turn back time. And when we think about it, for a lot of people, there's a bit of a waterfall moment there, isn't there? When the last child leaves university, or the last child who is doing a trade has finally moved out of the house, or they've become an apprentice.
Either that. What I hear more is the last child who's doing their trade. One day the parents see the pay slip in about their third or fourth year, and they go, "Hang on, this kid's on $26 an hour. What are you paying for dinner for?"
They're on more than us, and we're only charging them $50 board, and they're eating $150 worth of food. So basically a lot of money gets freed up at some stage. This is a really good one for those people because let's assume for the last 2 years they had that big expense where they had 2 kids at uni still, and then all of a sudden they graduate and get a job, and what they've found now is that they actually do have a spare $25,000 that could go into superannuation. They couldn't take advantage of it the last couple of years, but they can now, and so they catch up. So they basically put in $25,000 per person. In this example, it could be per person. It could be $50,000 per couple. In this example,
and all the tax treatment is the same.
It's the same
figures.
Same, just bigger numbers because of the bigger amount going in. So 39% tax deduction. They get back $9,750 for every $25,000 that they put in at a 39% marginal rate of tax. Just be wary that if you are on the tax bracket below that, 34.5%, it's just slightly less, but still well and truly worth it. Because you instead of claiming it at 39%, you're claiming it at 34.5%.
Yeah, but you're still only getting taxed at the 15% on the way into super.
That's correct. Yeah. So essentially, in this example, if they are on 39%, they put in $25,000. They get back nearly $10,000 in the personal tax return. They get back $9,750. The $25,000 goes into super. It's taxed at the same 15%, which is $3,750 in tax. The arbitrage is that they still get the same free money percentage of 24%, which is free money of $6,000 in this case. In that they pay $9,000. So they get an extra tax return of $9,750. They pay $3,750 in tax.
Yeah,
the differential is $6,000 of free money.
Yeah.
So
you go from it.
So let's assume that they do that for 3 years. They put in $25,000 for 3 years. They've effectively caught up then to the money
that they
can put in. They have to then cut back to $15,000. That goes in for the next 7 years. So over 10 years, this super actually grows by $217,000 and change. So by virtue of the fact that they were able to put in an extra $10,000 for a year for the first 3 years in that concessional contributions carry forward or catch up. So
and that's a good example of that compounding effect you're talking about, is that you in that first 3, even though for the majority of this time you're putting in the same amount as the first example, those first 3 years of extra contributions means that money's going in early. It's working for you in the background, even assuming that 6.8% after tax return within there. It compounds out, makes a pretty big difference. So as you said, there's just under $218,000, and that's per person. So you can kind of see there that, especially if you're a member of a couple and you've both got the ability to do this, it becomes a very big difference over 10 years.
Yeah, and there's a whole heap of other strategies that we can use to find that $25,000, to find that little bit extra for those few years. Yeah. We won't go into that now because there's enough to go in there, but we can do that when there's plenty that we can do that. Now there is a big caveat here.
Yep.
And the big caveat is that their total superannuation balance, which is the sum total of all the super funds that they have, has to be less than $500,000 on the previous 30th of June. So if I'm taking advantage of that now in 2021, we would look back on the 30th of June 2020, just gone, and if I had 2 super funds, for example, and the sum total of those added up to less than $500,000 it's per person, then I'd be able to take advantage of that.
Yeah.
It's a look back every year.
This has given me an idea for another podcast, which is because there is some management that needs to happen. If we're looking at this when someone comes in and they've got 490,000, so we go, well, you can do the carry forward in this year, but potentially next year, hopefully your balance will be over that. That's something that you'd want to manage in terms of how you do that, because you may not have 3 years to be able to do it. And
that's
so
right.
There's a bit of a trade-off to look at there. So, but that's its own probably kettle of fish.
It is its own kettle of fish. There are, look, if you've got cash savings that you can dip into, or you've paid off your mortgage and you dip back into that. Yeah. Again, we're not, don't take this as, we could get in a lot of trouble here with telling people to pull back on your mortgage,
whack money. So but
it's an alternative, and it's a strategy that you'd have to have an exit plan to. But it is a viable strategy, because we love free money. If we're going to, if we can. I mean, if we can do that, let's leave it. Well, it's a good idea for another podcast.
I feel like there is. We're mad for this sort of stuff, and we end up going down the rabbit hole in one podcast and end up sideways out somewhere else talking about all sorts of things. So let's move on to basically what we're talking about there is that's a really big advantage that you can, as you said, number one, the concessional contributions. Number two is the ability to carry that forward and use that up if you haven't been using it over the previous couple of financial years. So
yes, spot on.
So the third item, third legal loophole.
Yeah, so third is spouse contributions. So we did a podcast on this as well, and it was just
low income earners. Yeah.
It was a listener questions.
Yep.
Low income earners podcast. I think it would have been 78 or 79 podcast.
Yep.
I just can't remember. But go back and have a listen to that for these two as well. But spouse contributions. Yep. My spouse earns less than $37,000 in this example, and I make a $3,000 contribution into their super fund. Yep. So what happens is $3,000 goes in and isn't taxed. I'm entitled then to an 18% tax deduction or tax offset, which is $540.
Yeah.
So it's a free money percentage of 18%, or a dollar amount of $540 in this example. So again, we are all about the low hanging fruit, and whilst this won't make enough difference to be able to retire on, it's again an opportunity to put money into superannuation.
Yep.
Where, remember the mecca that we spoke about before, you're going to get this back tax free in the future. So it's just another opportunity to get more money into superannuation and also get a benefit, an immediate benefit for that.
Yeah, that's a good point, I think, because there's a lot of these things where you go, it's $540, which is still, there's a weird thing where people can be very blasé about, it's only $540. But if someone, if you went and got that amount out of the ATM and walked down the street and your wallet fell out of your pocket, you'd be kicking rocks for a week.
Well, you would. Like, I think of that in terms of, that's a week's worth of good entertainment, isn't it? Really, $540. Like, if you took that money out,
that's a big week.
It could be. It's probably a good fortnight's entertainment.
Yeah.
So for a couple. So that 1/26th of the year is covered by that little move there. And hey, what the beautiful thing is too, and this is the hidden gem, is that to get that, you've actually had to put $3,000 into your spouse's super fund. So an extra $3,000 goes in. It's just a little nudge to get more money into your superannuation. You probably wouldn't have done that if you didn't.
If it wasn't
weren't entitled to this benefit.
Yeah. And so that's number three, and the same, basically the similar sort of thing applies to the fourth loophole that you've got here.
Yeah, government co-contribution. So the earnings amounts are similar, not exact, but let's use the same example. So my spouse who has earned less than $37,000 of adjusted taxable income, we put $1,000 into their super fund. It can come out of joint bank account, doesn't matter. The $1,000 isn't taxed going in, so it's not levied at 15% tax. The government will then put $500 into that super fund, when the tax return is done. So the small caveat is that the tax return needs to be done. So if you have a spouse or if you don't need to lodge a tax return, then there's no way that the government can pick that up. So you'd actually have to go and get a tax return lodged in this case. But it's $500 of free money, which is fantastic. So put $1,000 in, the government puts in $500. Let's say that's another fortnight's worth of entertainment, that free $500. So it's again a nice little nudge. You've had to put $1,000 in to get that benefit, and in combination with the spouse contribution. So spouse contribution, you put $3,000 in to get $540 of tax offset. You put another $1,000 in as the government co-contribution, you get $500. So an extra $4,000 is going into someone's superannuation fund. Ignoring the extra, the $500 co-contribution actually does go in to the super fund, so it doesn't come to you as a tax offset. But so $4,500 has gone in. In this case, you've put $4,000 in those 2 points: spouse contribution number 3 and government co-contribution number 4. The government tops up with $500, and you get a tax offset of $540 as well. So, and that's kind of small ones there, but certainly well worth doing.
But again, over 10 years makes a big difference. So, we look at this a lot with, and as you said, 1, 2, 3, and 4. Each of these loopholes, they're really useful on their own, but they're particularly useful when it's all combined, and you see the compounding effect on that over 10 years. So, if you've got a couple and one of them is using up their concessional contributions carry forward and then using up their concessional contributions each year, plus they're making spouse contributions, plus they're making the additional $1,000 to get the government co-contribution. Over 10 years, those things all add in together to make a huge difference. And then
they do.
And then, as you said, the point of all this is that you're picking up those advantages along the way, but you're also getting to that endpoint, which is what you want to be in, which is the fifth loophole, which you've talked about, is the tax-free retirement.
Yeah, so here we come. We've gone over 10 years here, let's assume, and we've got to the point where we want to retire. We're over age 60. All this money that we've put into our super funds along the way, the concessional contributions, the carry forward, if we're entitled to it, the spouse contributions and the government co-contribution, means that we actually have a larger balance than we would have had. The mecca now is that once we've met a condition of release, which is there's a number of these, and the most common one is that I'm aged over 60 and have retired.
Yep.
But it doesn't have to be. So you can
cease an employment arrangement after
if you cease an employment arrangement.
Let's not do it. This will be another one of those things. We've been talking about this for half an hour, and then we'll go on for another 10 minutes about different conditions of release and how to do that. So,
that's right.
The big picture there is that, as you said, you are able to meet a condition of release. You can move your money from superannuation into a superannuation income stream, or as you said, a tax-free company. And in that environment, you pay no tax on the earnings, and you pay no tax on any income drawn out of there.
Yep. So let's assume that you've got your superannuation balance to, let's say it's got to $1.6 million in this case. All of that can go into the tax-free company that I spoke about. It's called, this is why it's confusing as well.
An allocated pension, an account-based pension.
A pension.
Well,
The most common term for this is an account-based pension. Look, we like to call it a superannuation income stream, which it's also known by, because that's just what it is. Like it's still a superannuation fund. The tax rate drops from 15% to 0%. And what it is, it's designed to pay me an income stream in this point in time. So there are a few little minimum requirements that you do have to take a minimum income from that. There's no maximum income. that the maximum is set by how much is in the account and how much is sustainable to draw down, how much you're making as a rate of return. Just the same as you can withdraw money at any point in time from a bank account until it runs out. So you have to be careful there. There's essentially no maximum that you can draw. It's 0% earnings tax. So just imagine for a second that $1.6 million that we have in this fund here earns us an 8% rate of return. So effectively it's $128,000 of earnings that we've earned, and there's absolutely no tax levied on that at all. You can draw tax-free income from that as well forever and a day.
Yeah.
So
and I actually like the example that you've used here of what that means in terms, because I think what happens when people are working, tax is taken at the source, and so people obviously don't necessarily realise how much of their gross income is taken up in income tax because it comes out every fortnight. But in the example that you just said there, if you were drawing an $80,000 tax-free income out of your superannuation income stream, to receive a net income of $80,000 from work or from your job, you'd actually have to have a gross income of $110,000. So it's a huge difference there.
Yeah, so there's a differential of $30,000 in that I can draw $80,000 tax free from this magical company, superannuation income stream, and like you said, Dallas, if that was employment income, if you were receiving $80,000 in the hand employment income, you'd actually would have already paid $30,000 tax from your payroll tax.
Yeah.
So there's a big difference there. Free money of $30,000 a year in that example, and that's forever. So imagine what you could do with $30,000 extra every year in save taxes. Like there's a lot of stuff you can do with that. So just to talk a little bit more about that, because it's a really confusing thing for people, because it's called an account-based pension or an allocated pension, or it's referred to that. I've had some questions where people have said, do I have to go into Centrelink? And and I was, it's the word pension actually confused them, and I can see why that was. There's been confusion around how long you need to tie this money up for. So there's no need to tie any of this money up forever and a day. If you want that money, you can cash out that in part or in full at any point in time. And there's been confusion around where you can invest that money. So same. Just keep thinking back to superannuation.
Yeah.
Whatever you can invest in your superannuation fund now, so you can mix that around bonds and the best companies in Australia and the biggest companies in the world and all of those types of things. You can invest in the same things inside a super income stream / account-based pension. So
and that's why we actually call it a super income stream, is because it's I guess an easy way to think of it. It's just like a super fund. It's exactly the same as your superannuation fund. It's just that it's designed for you to draw an income from, and it's taxed at 0%.
Yes, it is the absolute mecca of where you want your money. The main caveat is that you can't start one of these with more than $1.6 million per individual, which is important. So what we find, we see some scenarios, Dallas, don't we, where say one member of the couple who's done most of the work, and the other member of the couple may raise the family and all that sort of stuff. They end up with vastly different superannuation balances. There's some tricks that we can do. In this example, if someone was due to end up with $1.9 million, and someone else was due to have $0 in their fund, what we'd want to do is actually move over at least $300,000 from that $1.9 million into the other person's fund, the other member of the couple's fund. And the reason is that it's a limit of $1.6 million each that you can have in this tax-free company. So
And that's another one that is probably a podcast all of its own, how to square that up. There's a heap of different strategies as to how you can do that, but I think that's probably the main caveat, the main point to leave there is that's really the holy grail. Is what you want is up to $1.6 million each inside superannuation to be able to get it across into that tax-free company and tax-free income forever and a day.
And we're certainly, as you can tell, if you've listened this far, we are so passionate about this. This is our business. This is it. This is our life. Yeah. So we love this stuff, and we can put all this. We put all this together. We'd be only too happy to talk to you about actually coordinating all of this together. We've given away a lot of stuff here, but that's fine because. Look, Roger Federer knows how to play tennis, but
I knew you were going to pull the Roger Federer line out.
Look, he's still got a tennis. He probably knows more about tennis than anyone in the world, but he still has a tennis coach. He still has he still has a trainer. He still has all those people to hold him accountable. So, I mean, what we do for a lot of our clients is, besides putting all the strategy together, we actually hold them accountable and we make sure that they get to where they've said they want to be. And obviously legislation does change as well. So if we're looking at 10 years to go or 15 years to go, we see legislation change a lot. So this is the current legislation, but 2019-20 alone, here's the new legislation that came in: JobKeeper, early release of superannuation, the halving of the account-based pension minimum income requirements. We had concessional contributions carry forward actually kick in, even though it was enacted beforehand. It really only kicked in 2019-20. So
this is probably that's just in 1 year. We could be doing this every year or two with all of the new legislation, the new rules, and different limits, and all the things that are changing all the time. So, and I think that's, as we said, the main thing here is that here's the 5 sort of off the top of our head that we can go bang, 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 bang. This is what we can take advantage of. But it does then tie into the bigger picture. We want to have a plan as to how to use all of these in the most effective way. So we don't want to be taking advantage of one of these at the expense of what that puts you in the future and your ability to save tax down the line as well.
That's exactly right. So probably a good place to wrap up. If you do want to get in contact with us, certainly podcast@mo50.com.au. We'd certainly, please reach out. We'd only be too happy to set up a Zoom meeting. We can talk to anyone around Australia, wherever you're based, because it's certainly post coronavirus world, everyone knows how to Zoom and everyone's pretty comfortable with the Zoom meeting. So it's good. We found that's worked really well.
Yeah. Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Lighthouse Financial Advisors. We look forward to catching up again soon.